his stint uh, at uh, at Alliance Capital Mutual Fund, which was one of the private mutual fund, which he was the CIO for global emerging equities and Asia Pacific, and uh, and he went on to set up Helios in 2005. So Helios is not a new name per se. Helios has got a track record of about 20 years, uh, and the entire investment team, they've been they are market veterans. They most of the people in the investment team have got over 2.5 decades of investing and investing experience, especially on the equity side. So very vast experience of the team. And uh, and then 2010, Helios got into an agreement with ICICI Prudential to advise them on one of the PMSs. That agreement went on till 2019 before Helios decided to come on their own in India, and started with taking over the same PMS, or moving the same PMS strategy to our platform under the name of Helios India Rising PMS, and then launching AIFs. And then obviously the mutual fund happened for us. I will discuss in detail why and how did we venture into the mutual fund. But that's how the journey has been. We manage over $1 billion now cumulatively between the PMS, AIF, and mutual fund. Mutual fund by itself on a standalone basis has grown over 4,000 crores, and out of that, our flagship fund, which has over about 15 months of track record now, over 15 months, has is the largest, which is about 3,200 crore plus. So that's largely how the context is. I myself come with about over 2 decades of experience in institutional business, and then retail sales and distribution products. And then in my last assignment, I was heading the alternate PMS business for ICICI Prudential Asset Management before moving and taking over this responsibility of Helios Asset Management as head of business. So that's briefly about me. Now coming to the market outlook right now, I think I would like to explain it in two parameters. One is the strong macros which India hold on to right now. I think from deficit in terms of liquidity to moving into surplus, thanks to the RBI for the fantastic job which they have done. I think it's commendable, and with following it up with the rate cuts, and also the tax sops which is being given by the central government, government spending coming back. I think these were the missing parts in the last quarter, which sort of due to the election and sort of pushed us into uh, environment where the consumption had slowed down, where the growth had slowed down. And obviously the equity markets that tracks the consumption, domestic consumption, and the growth in the economy had obviously were overheated, and was looking out for some cues to correct these issues which were there, which actually happened also when with the budget and then with the rate cut. But for our bad luck, I think Trump came into power, and Trump turned it around with this trade war, onset of the trade war, and then followed up with Pahalgam, which has happened, which is unfortunate, and yeah, so on. So at right now, I think on a structural basis, on a long-term basis, we believe that India's story stays intact. There is no moving away from that. In fact, what we believe is that the structural bull run which we have seen in US, and the kind of gains which some of these stocks have enjoyed, especially the top seven stocks in US. I think with whatever is happening in US, has pushed the investors to rethink about their asset allocation strategy. In fact, what I hear about is that some of the investors have already been reallocating, and we have also seen some flows coming into India. But on a big picture sense, what we believe is that US from 2020 levels, where they were of global market cap in terms of, hypothetically, they were about at 45-50%, they're about 45% roughly, and from there they have moved to about 65% right now, in terms of the global market cap to US allocation. And sorry, the global sorry, the allocation which they have. And in our reckoning, even if we look at that, even if do some calculation and believe that even 5% of that asset would shift and will get redistributed in the entire emerging markets, not only us, I mean, there is Vietnam, there are others also, right? We can see a sustainable and significant inflow coming. Even if we get of that 5%, we get 5%, in the hunch is that it could be run into billions of dollars, lakhs of crore. In fact, the estimates are quite encouraging, if you look at those numbers. But not quoting those numbers because those would be extrapolating the thing right now. But to, just share with you, I think, there would be flow reallocation which will happen, which would, which will get us to one scenario where, all this while we have seen FIIs selling, now we would see FIIs and DIIs both buying. So I think, we will eventually get into that scenario. But in our reckoning, I think, even the forward returns would come with a lot of volatility. While returns would come, but it would come with volatility. So that's gonna be there because of one the geopolitical tensions which are there. Second, the US president, who's there at the helm and who believes in waking up with some statements every morning. I think these would, keep investors confused, corporates confused, right? I mean, so these implications would be there, and which will obviously, we are not scared, we are not, away from that. I think we would also be rubbed, to certain extent, as and when these things happen. So yes, so return expectations, structurally nothing changes. India story stays intact, but the only thing is that, forward looking, I think there would be some volatility. It won't be easy. It won't be cool environment to buy and hold, and so on and so forth. And hence, in these kind of environment, structurally, a philosophy like ours makes a lot of sense. We follow something called as elimination investing, which basically has about 8 key criterias and 2 level of screenings in that. The first level of screening not only takes care of, the size of opportunity and where you are investing, and so on. Uh, uh, you know, uh, 1 minute, I'll just share so that you can see. Yeah. So, so the first level of, screener not only uh, takes care of, so these are the, 8 criterias. So how did we land at these criteria? So, if you look at the big picture sense, the philosophy has been derived from here, where we did a study of the entire market. We have this data for past 20 years, and what we saw is that in any market, market is an average, give or take, and there are companies which outperform the market. And as you can see on your screen, a substantial part of those companies, beat the market, even on a higher note. And a large and similar amount of companies gets beaten by these, the market. So the objective was to understanding this reason, and then, not doing this mistake, so that, you don't fall ever into this criteria, largely at the point of investment. You are not making those mistakes so that you fall into this kind of this box. And the reasons which we identified were these. Now, out of this, what differentiates us from the crowd is this: the philosophy itself. It's called elimination investing philosophy, which is slightly different than the process of selecting, or selection, and it has been also reinstated by Nicholas Taleb in his book called Skin in the Game later, which says that via negativa is less error prone than via positiva, and less error prone and more convincing than via positiva, because even in life it is said that what we don't want to do, we are more convinced about that than what we want to do, right? So it if you can get this example from your real lives also and test it, and you can see that it really it is like that. We are most of the time we are convinced with what we don't want to do than what we want to do, right? We all parts of life. So so same is same goes here, that via negativa, the method of elimination gives you a lot of conviction, because that where you don't want to be, what are the reasons that stock underperform. If you are able to eliminate those reasons, the probability is that you are somewhat moving towards the upper orbit of these companies. And there because no because we also believe one thing, that nobody can predict the future. Nobody knows anything beyond anything, beyond a point. And hence the philosophy is constructed in that way. Now the USP of this philosophy is, while you will see that the point number 4, 5, and 6 is present in everyone's screening method, right? It's some or the other way. But what's different here is the size of opportunity check, the first and third criteria, which is basically that investing or focusing your investment on the segments or pockets of the market which have got tremendous tailwinds to grow, right? So as we've been seeing that in an emerging economy, you have financials, which or basically something which is gaining market share from a public sector enterprise, wins or gains higher. Then once that is largely restricted to BFSI in today's construct, but there is infrastructure, there are education and all that, where private sector is gaining from public sector. And then the second criteria is that once the financialization of the economy happens, then there is consumption which kicks in. And in India kind of an economy, it is more of mass affluent consumption. So we have pocketed, or we have called that basket as demographic shift, or lifestyle changes, and all the new age businesses, right, which fall into this. So in a way, even though we are like 3 decades in the our investment team is like 3 decades in the investment space, they are quite young at heart in terms of accepting and investing in the newer ideas. And that's what you would see in our portfolios, that we are pretty open for new age ideas which are disruptors, which can potentially grow big. And we have a quite early understanding of these changes. And then we are very sort of open to look at these ideas way ahead of others. So that would be another thing which is basically the USP on the upper end. On the bottom side, you could see that with the 7 point number 7 and 8, which largely takes care of the short-term volatility which a stock brings in. Now these are largely attributed to reasons such as the recent financial performance, or the growth aspirations, or the growth prospects of the company, and the valuation which the stock is commanding in the market. So we assess this independently. And and this is so while the medium term trigger or the recent performance is evaluated through or forecasted through most of the managers, what we actually look at specifically is that companies which are offering growth at a reasonable price. Growth at a reasonable price does not mean that we are cornering ourselves to value, or neither are cornering ourselves to growth. So we like to always have a company which is growing, which can potentially grow, but it is also reasonably priced. Now that reasonable pricing could be, maybe a 70p stock has corrected to 30 or 40, right? It might look slightly expensive also, but if it is offering me that kind of a growth, we don't shy away by taking calls on such companies and consistently evaluating that. So these are some of the highlight point where which makes us stand out in terms of how we construct the portfolio. The second point is obviously the construction of the portfolio, where we try and do so. Once the stock selection has happened, the movement happens to the construction part of the portfolio, which is also strategically done. So what we try and do here is that while when you will see our portfolio, you will see some of the very known names, but in between you will see a blend of not so very known names, right? So basically we try to blend between good companies and emerging good companies. Why we do that is essentially when the good companies are there, these are companies which actually give you higher confidence for investing in them. But this confidence comes with their history of track record, and with this history of track record, it is also should be assumed that it is widely known to the people. So there is no discovery element, and when there is no discovery element, there is no PE expansion which you can get, or PE re-rating which you can get in these company. They grow at a normal market plus kind of a rate, and that's where that alone will not help you beat the broader index of a 500 market, which because it also constitutes a lot of companies which grows at a higher pace. So the point is that you need to have another set of companies, which we call it as emerging good companies, which basically offer reasonable confidence. You are confident while doing the stock, while putting it through your elimination investing machine, or investing framework, that that and screening out the ideas. Know that there is nothing visibly wrong or seen wrong in this company at the point when you are starting. But the point is, as you move along, I mean, you see these companies grow, and with the one grows, basically you keep them in the portfolio, and the other ones, you sort of weed out. So what is the USP of this is that you identify these stories much earlier, and these through selection process, they don't have recent established listing history track record, and thus you take slightly smaller bet, you spread your bets between multiple companies, and then you keep evaluating them. Thereby what you are doing is that you are diversifying your risk of cost of error in these companies, number one, and number two, you are also entering these stories much earlier than maybe your peer set. So there you can expect slightly higher kind of returns coming to you, and both put together sort of delivers you a can deliver you potentially a much consistent and a slightly higher kind of a return over the index. So that is the model which we follow in terms of investing. Uh, Coming back to our product suite right now, what we have is basically we have flexi cap on the mutual fund side, and then we launched balanced advantage fund, which is basically about people who we run a very different balanced advantage fund. In fact, we don't take any debt call in that. We run equity and arbitrage kind of a portfolio in that, and it is based on the model which we've been following for many years, since we've been doing at Helios a long short fund for over 2 decades, and that kind of a model has been followed, and that has worked well, right? So that is followed in BAF. And then we did large and mid cap, financials, which is one of our favorite theme, and then mid cap. So these are the products which are right now available from the house of Helios. A part of that, we have our PMS, which is India Rising PMS, and Helios India Long Short Fund. So that's largely the product suite which is available. And yeah, so I think I have covered, what was asked for. I am open for questions right now, and then we move forward with these questions. Thank you.
Saurav, over to you now for asking questions. एक क्वेश्चन सर मैं पूछना चाहूंगा because these are all partners of elite partners of Nirmal Bank. So if they have to pitch flexi cap which is approved in their system, so ऐसा कोई 5 USP point जिससे they can approach their client for getting allocation into the fund.
See, I will show you. So while I had, shown data, what we do actually in this, there is another data which is very, very important for you to look at, is this, that 80% of time we are, around the themes which have got tailwind, right? And then 20% of time we, try and identify the new trends which is there, and we invest into those, right? So that's how the blend of theme is. And you would see that through this data you can see this is basically of our PMS, which is also flexi cap mandate, because this is the data which I have to show it to, in terms of how the movement of how the movement of themes or rotation of themes happen. So you can see that like, say for example, in 22 in our PMS, we exited from completely we exited from tech, and then in fact we came back recently, but again exited for reason which I can share. But you see that that get reallocated to theme 2 and theme 1, and then so there is very actively managed thing which is happening on the theme side. A part of that, if you look at market caps, what is that we've been doing is that we want to be a true to label product. So if you see, this is PMS data of ours where we have run flexi cap mandate. You see that over a period of time we have gone as high as 80% in large caps, and then we have dropped it down to 51% kinds, right? So that's the kind of swing we do. So these are two things. And the third and fourth thing which I explained through the philosophy is, one of the point is the blend which we run in the portfolio, or the mix which we run in the portfolio is a very healthy mix which we run. And then the 2 points, which is that what is specific to us in our philosophy is basically identifying or evaluating the size of opportunity of the segment of the market. And then second, also identifying the potential for candidate for disruption. Like, say for example, we were not there in auto for some time, right? Right now we think that IT is facing some kind of a headwinds due to AI, right? So these kind of things. And then obviously the price which we pay for the growth and the evaluation of that. I think these are 3 4 things which makes us stand apart from the other managers. Yeah, so I think these are the 3 4 points which people can take back.
Thank you,
Yeah,
sir.
thanks, Devi.
Mhm.
So I would request, let's say, people in chat, if they want to ask any question, you can just type it in the chat box. Meanwhile, Devi just wanted to know, let's say, definitely in market, there are multiple flexi cap which is there from last 2 years, or maybe I can say last 2 years we have seen a decent upside in this category, and it's a center of attraction when we compare with any other fund houses, right? So in that situation, taking a call with a new entrant, definitely backing by with a renowned guy of Samir Asija, but again, it's we have seen there are so many AMCs have come, but performance and brand plus a person is three different things. So now, how as an investor or as an advisor, somebody should give that kind of a confidence. He know Helios is the one which you can trust, and definitely being the first fund, I think, flexi cap of
Yeah.
yours, right? So it has a special attention, a soft corner for everyone, and you can reach out to all our investors for that.
Yeah. So so answering the question that why Helios should be looked at, I think The first and foremost thing is, I would like to say that don't look at it as a new entrant in this. It is like this, that after someone working for decades in a if we have accepted Swiggy and Zomatos in our life, so or maybe Grow and Zerodhas in our life, then we should also accept the newer AMCs in our life, because what is happening is that people who've been setting up these in some of the other brands have now moved on and started on their own. And in our field of investment, what matters is the pedigree of the investment team, the experience of people, because they are the real brains behind that, right? So I think from that perspective, investors, we have seen a lot of acceptance for us with Samir being there at the helm of the thing. And even the fund manager, if you look at, I was seeing some of the managers, and I don't want to comment on that though, but even my CIO comes with a 3 decade of experience, right? He's been with the fund house for 20 years, right? So if you look at the pedigree of people itself, it's very, very different. And it's like a startup, right? Experienced people, they come together and but these guys have not come together for setting up mutual fund. They came together in 2005 to set up a hedge fund. And then after doing working for almost now again 20 years, they came up with this idea of going into retail. And essentially, I was talking about the theme, which is basically lifestyle changes and mass affluent consumption. The idea of venturing into mutual fund came from there. If you look at, we were doing, we keep talking about it, and we in that, wealth management also becomes, or maybe wealth management also becomes one of the part of that. And we were always bullish about that India can grow multifold. If we are talking about a 3.5-4 trillion economy, doubling to 10 trillion economy, and if your mutual fund to GDP is about 16%, if on both leg, which is basically the 16% grows to say about 25-30%, and then your GDP also becomes 3 times, this industry by itself can have a potential to grow 3-4 fold. And we and the retail, which is right now investing into traditional asset class, 50% of our household saving gets channelized still into the traditional FDs and all that, right? So it is yet to, the cult is yet to become wilder in the on the mutual fund space. And that is the reason why we launched our mutual fund, because we firmly believe that there is a lot to happen on the mutual fund space. I think people never imagined that we will become this big, right? But we can grow multifold. This is just the tip of the iceberg, according to us. So we believe that, and that's why we are there. So it's like, look at us from a perspective, experienced people starting up on their own, and they managing your money. And it's regulated by SEBI, and our Helios is Singapore is also regulated by SEBI. So they've been their license for a very long time. So I think there is these are the points which should be put forth in front of investors.
And so we have few questions from the audience. That
Yes.
are there any global risk or trends Helios is currently watching closely? But definitely, we have seen market volatility in the last couple of months due to war tension globally, right? So, do we expect that things have eased down and we can see a range bound market for the next, maybe the next financial year, or at least till 2 or 3 quarters?
Yeah, so see, two things will work in our favor, is the base effect, in terms of growth. And then obviously, this time on the top 100 companies, at least we have seen some kind of earning surprises, right, coming in between the top. But otherwise, if you look at the broader market, there is still pain in that part of the market. And what we see is that there is global headwind, largely due to the risk which we run from the US. I think that will keep people on toes. Otherwise, from India perspective, we don't see so much of challenge. India perspective, we don't see so much of challenge. But yes, as you've been asking, and I have also commented earlier that the returns, expected returns, because see, India has gone through its phase of correction, right? Largely, we expect returns to come, but returns would come with a lot of volatility, right? So the point is that investors coming at this juncture should definitely look at some bit of higher horizon. The way returns were made in the past 3-4 years, I don't think so that kind of returns can be expected, and those kind of returns will be made from equity. So volatility would be part of this, because of essentially the US president being there at the helm of the things, right? So he will come up, wake up, and make some statement, and that would impact the global markets. So yeah.
We have next question. How does Helios approach the stock selection, looking at the current market economic, right? And definitely we have now two funds. I think three funds.
Yeah.
So one is Helios Flexi Cap, one is Financial Services Fund, and we have a third one.
Yeah, so we have flexi cap, we have financial, we have large and mid, we have mid cap.
Four.
Yeah, yeah.
So in that, definitely. So is that in all the four funds the stock selection criteria is same as a
So
as
the
a
so
fund
the
house? Or
elimination, yeah, so
yeah.
elimination investing remains the base, right? So basically eliminating stocks based on the negatives remains the same. But yes, stocks are different, right? Weightages are different. Like if you look at my mid cap portfolio, it's very, very unique, right? It's beautifully constructed where the weights are restricted below 3%. Largely, we wanted to restrict below 2.5%, but there is one stock which we bought, which is at 3%, which has done well also. But otherwise, a large part of the portfolio is below 2.5%. And that is how we want to run a mid cap, because, our philosophy of owning the emerging good companies is that, you diversify your bets between multiple companies at a range of 2.5%, and, continue with it in that way. So, yes, so that is, what the philosophy on that front is.
We have, maybe we can take this a last question, that this is a query regarding your mid-cap fund. What are the key differentiator and unique features of this fund compared to other mid-cap funds in the market? Uh, I noticed that it has delivered close to 13% returns over last 3-4 months. What factors have contributed to this performance, and what is the future prospect about this fund?
Sure. So I would like to take one more question, which is mentioned here, the current macroeconomic environment. So, we came up with this fund. So basically, macros are something which we consider at Helios very much, right? So if you see our thematic calls, you would see that, we had exited tech, then we entered tech last year, right? So we do all these things. We take, and not only macros, we also consider what's happening in US, right? So global markets also be considered, and accordingly we take our call. Now, what formulated the returns in the mid cap is essentially the timing of the launch, right? When the entire market was crying, we were sticking our neck out. There were people who said that even stop your SIPs, and in small and mid cap, we came out and we said we launched our mid cap fund, which we were keeping in our pocket for last, for almost 2-3 quarters. Last year it got approved, and at that point of time we were, mid caps had gone through corrections, and we were like, looking at and staring at some of the ideas which looked very compelling to us. And then we decided to launch that, and within, and the trigger points were the consumption, kicker, which, the budget gave, and further that got, reinstated by the rate cuts which RBI came up with, right? So the rate regime change and the consumption boost which the budget gave, I think, were the primary reasons why we came up with that, which I think our call has gone right. People have, investors who made investments have made money. It's a very beautifully constructed portfolio. I would urge partners and investors to look at, or, your teams to look at it. It is different. How it is different is, obviously, the elimination investing is one of the very, very key strong point about that it is focused largely on some of the themes which have got tailwind to the economy, right? So that one. And second, you will find stocks which are not, so in general, the assumption is that in mid cap you will get kuch bhi, I mean, you will get some stocks which will have no which will not make sense. I think in my portfolio, if you look at, you will see most of these stocks make sense, essentially because they have growth prospects and they are available at a decent or acceptable valuation. That's why they're part of the stock. But the biggest point here is that the diversification or the construction of the portfolio, which is, very, very, very strong, right? So there is no stock which is above 2.5%, right, in the portfolio, and it will never be the case also for us. So we want to run that product in that way, and then also shift, between the themes. And the third biggest point is that, we want to run it like a mid and small cap. So, there would be about 65% mid cap and about, rest would be in small cap. So, that flexibility we want in that. So we want to run that product also that way. So, these are 3 4 points which is different in our. So we don't want, at any point of time, our idea is to not get large caps into that, right? That is the thought. Yeah.
Devi, just like to add, all our schemes are true to be labeled portfolio, as Devi has mentioned. We will be having a mid cap and small cap. We will not have any large cap in our mid cap fund. The same way, if you see to my large and mid cap, we don't have any small cap fund. Whereas SEBI allows somewhere between 15 to 20%, and most of the fund managers run all the schemes or the portfolios into the similar lines. But our particular, all the schemes are true to be labeled a product. So mid cap will not have any large cap, and that is the biggest differentiator. And this is a very young portfolio. It is only 2 months into existence, not 3 4 months, and 2 months 13% return. And this is a time when the fund is very young. All the stocks which have been bought in this portfolio are beaten down, and we were not having any history of the existing stocks where we were adding, and we are not seeing any redemptions because it's a new fund. So we are building the portfolio at the corrective levels, and that is able to deliver this sort of a fantastic return. And henceforth, we also recommend any people who is in the wealth creation journey should look at our mid cap as a product.
And another point, which is there also as a question, which people should, take a note. So this is basically the peak of the market, 26 September, and this is largely the recent bottom, 6th April. And this is how our flexi cap has done. So, while there are flexi caps which would have fallen upwards of 20, 15, 20%, I think you will see that we are at the bottom, right, in terms of. So we were amongst the top 4 during that time who could, outperform the market, right? So that's another, thing which is which people should take note of. Yeah.
I think I just to add, that's the beauty of the new age AMCs, because since you don't have the baggage or the history, you are the free bird to perform in the any situation.
Yeah.
So I'm pretty much confident in the last, and this is for everyone, that last 3 4 years, we have seen the new entrant as delivering a decent performance. And only thing is we need to watch the how the fund management team is, how the CIOs and CEOs is working closely in terms of stock picking and making the portfolio, right? So those were the days when only the big shot used to give the returns. Now this is a time where if you have the right portfolio, right mixture of the stocks, irrespective of the brand name, the delivery of the returns has to be there, right? So last question from the Helios team. One fund, let's say if somebody wants to take it to each and every investor of their portfolio, it should be a flexi cap fund or mid cap fund looking at the current market situation.
So current market situation, see, I think I would, so there are two kind of investors: the investor who is ultra conservative, flexi cap, and the investor who has a view of 3 year plus, I think, mid cap. So these are the two pockets of investor. There would
दोनों में
be,
पैसे दे दो.
both are good products, both
Yeah,
are good
true.
products, and investors should, look at these products. Yeah.
Right. So definitely,
तो
but
एक
still
में आप
looking
लमसम
at
कर सकते हो और एक में आप STPs SIPs कर सकते हो.
that's the even best way, because I also still believe that if you're taking a call in a mid cap fund, so for the next 2 3 months, if doing a decent STP will
Yeah.
fetch you a decent returns.
Yes.
And definitely flexi cap is a all-time favorite, like an Amazon Proceed, which you have in your home. So
Yes.
done. So thank you everyone. Thanks Team Helios. Thanks Devi, Prashant, and
Thank you.
Indrajit for guiding us. And
Thank you very much.
yeah. And definitely, I'm sure in the next 30 days, you'll see the turnaround in the Excel. So that's the key of the entire efforts.
Sure. Thank you very
Sure.
much for having us here, and we respect your time, and thanks. Thank you very much for taking time
Thank
out.
you, Saurabh. Thank you.
Thank you.
Looking forward for your support now. Thank
For
you.
sure. Thank you.
Thank you,
Everyone.
sir.
Thank
Thanks.
you, Saurabh. We are all around. Anything, any time required. My team is there on the ground. We are very well connected with each and every member of my team. So anything, we are just a phone call away. Looking forward to
Done.
it. Okay.
Sure. Thanks, Prashant.
Thank you.
Yeah.